So something happens in your life that makes you finally realize, hey, I got to ask for some professional guidance here. Maybe it's retirement. Maybe it's a loved one who passed away, or you changed your job, or hey, maybe you just want to just get your, what together, right? Regardless of the reason, the real question you need to ask yourself is, how do you go about finding that right financial advisor? Follow me into this next episode here. What I'm going to give you is a list of questions that actually are important for you to ask and for you to know. I'll even tell you how we here at Stonehouse stack up in those questions. And later at the end of this video, I'm going to give you what I feel is the most important advice, because it's where most people really get stuck along this process. Now let's go. Welcome back to another episode of Blue Collar Wealth. Again, I'm Bob Brown, one of the founders here at Stonehouse, and today we're diving into a crucial topic: questions to ask when looking for a financial advisor. Choosing the right financial advisor can make a significant difference in your financial journey. But how do you know if you're picking the right one, right? That's the big question. So here are some key questions that I want you to ask. Let's start with a question that I think is vital. Are you a fiduciary? A fiduciary is legally obligated to act in your best interest. It's a crucial distinction because not all financial advisors are fiduciaries. Knowing this answer can give you peace of mind that your advisor is making decisions that benefit you, not just their bottom line. I like to describe a fiduciary this way: like if I were you sitting where you are, with the same set of circumstances that you've just shared with me, and knowing all that I know about planning and investing, would I do the same thing with my money as what I'm recommending to you? That answer should always be yes. I think this one is vital, and that's because, of course, Stonehouse, our advisors here, are obligated to act as fiduciaries. And qualifications matter too. So the next question to ask is, what are your qualifications and or certifications? You may want to look for advisors with recognized certifications like CFP, Certified Financial Planner, or CFA, Chartered Financial Analyst. There's more out there, but these credentials basically indicate a level of expertise and commitment to this profession. At Stonehouse, we have a mix, some with credentials like these, others without. And I can say that with confidence that just having a certification does not automatically make an excellent advisor. I have peers who don't have any such certifications, but they're fantastic at their job. And every day they're out there advocating for their clients. But having those credentials does show an extra effort toward learning their craft, and that can be important too. Speaking of extra effort, the financial world is always evolving, so it's important to ask, how do you stay current with market trends and changes in financial planning? A good advisor should be continuously learning and adapting to new information, whether it's through ongoing education, attending industry conferences, subscribing to financial publications. Staying up to date is key to providing sound advice. And I'm really happy to say that we do all those things and even more, including my favorite activity, which is our Stonehouse Huddle. Each week, our whole team of advisors assembles to share thoughts and ideas, and we discuss industry trends and unique scenarios, which allows our collective experience to hopefully provide a better service to our clients. Next up, how do you measure investment performance? This question is essential too, because it helps you understand the advisor's benchmarks and whether they align with your financial goals. Now, you might be saying, what does that mean? It means, are they comparing your portfolio to a specific index, or do they have other metrics in place? It's important to know how they define your success. We send quarterly reports at Stonehouse to our clients so they can easily see how much their accounts have in them, how they've performed, and how their entire household has performed. So we also try to benchmark each client with a relative peer group. For example, it makes no sense to compare an aggressive 40-year-old investor contributing a ton of money each year against a retired 68-year-old who's drawing 5% of his money from his conservatively invested account, right? It has to be apples to apples, aggressive to aggressive, conservative to conservative. That's how you should measure a peer in benchmarking. That's as it should be. Next, ask them, how do you assess and manage risk in my portfolio, right? Risk management is a critical aspect of investing. You want to ensure that your advisor has a clear strategy for balancing that risk and reward, but tailored to your risk tolerance and financial objectives, right? Do they use diversification, asset allocation, or other techniques to mitigate risk? And I'll throw a spoiler alert to you. It's highly likely that everyone you interview will already do all those things. But do they really understand what you are comfortable with? A good advisor needs to do more than simply fill out a risk form so that they can say they did it and stick it in your file. Most people we work with could answer those risk questions on their own without our help for sure. But if you ask them to describe what they just completed and what it means, they'd probably struggle, right? So the right advisor, the type of professional you should be looking for, is someone who takes the time needed to be sure that he or she's capturing your tolerance, your preference, not their own. And they should take the time to make sure that you understand whatever they are advising you to do. So in summary, I'd say that those questions are a great place to start for sure. Now, I want to drop in some additional tips here, right? Tip number 1, the right financial advisor, should do exactly what their title states: provide advice. Not try to sell you or push you into a product or a transaction, but rather advise you on the pros and cons of what you're facing. Then from there, they should make recommendations, provide you with justifications so that you can understand why they think that that's good advice for you. Tip number 2, don't you dare walk out of that initial meeting without understanding how that advisor is paid. This should not be a difficult or uncomfortable question to ask or for them to answer. For good advice, you'll pay good money, but how much is it? For example, when someone asks our advisors at Stonehouse, we love being transparent about it. We simply say that we are typically paid an investment advisory fee that is a percentage of the assets we help you manage. It's usually charged quarterly, and when we send you that statement, we'll also include a full report of how your assets are performing, including the details of how we just calculated that fee. We also tell them that based on our research, we find that we're usually not the cheapest, but also not usually the most expensive either. Our focus, our goal is to be a very affordable option for you, but try our best to provide the most value for the trust that you put in us. That's how we get paid. I caution you to watch out for 2 types of answers when it comes to fees. 1, stumbling and bumbling. If they get timid, lose eye contact, start to squirm in their chair a little bit, those should be red flags, regardless of the industry, right? Whenever someone shows those signs, right, they're not confident or proud in the offer they're giving to you. Number 2, watch out for cleverly worded phrases. I see a commercial out there in our industry that says, "We do better when you do better." People say to me, that means that if they don't make me money, they don't get paid. No, it does not mean that. I agree that it kind of sounds that way, but in reality, that firm is paid in a very similar way to how I just described our advisors at Stonehouse. So if you have $500,000 invested with that firm, and a year later you still have the same $500,000, they still got paid. It's just the same percentage based on your account value, which means they're getting paid about the same as they were last year. If your accounts go up, then they're charging you that same percentage against a bit of a higher account value. So your value went up, and they gave themselves a bit of a raise too. That's how that works. See how you have to sift through the BS and the cleverly worded phrases and just ask them to be clear until you understand how they get paid. Okay, tip number 3. It's going to come down to your gut. It really is, and it really should. Here's what I mean by that. At the end of the day, if you interview 2, 3, 4 different candidates, your head will be spinning. Each will have answered those questions a little bit differently. Unfortunately, you'll have a hard time remembering everything that was said at each meeting and organizing their answers in a way that you can kind of really show and compare, right? That's completely normal. But here's the good part. One thing that will probably not be forgotten by you is whether or not you liked the advisor. I'm being very serious about that. I know it sounds kind of odd, right? I just gave you a great list of questions to ask, and that should yield you some really good data points to kind of sort through. But was gathering data to build your own spreadsheet and do your own analysis really the reason you went through the interview process? If it was, then maybe you're actually the type of person who should manage his or her own assets, your own assets, right? In my opinion, the real reason that you interview these people is to get a feel for how they handle themselves. Remember, when you're dating people before you chose your spouse, right? Or think about the folks close to you in your life, right? Here's my analogy I always do. Did you choose your spouse because of a fancy answer they gave you during a nice dinner date? Did you become besties with somebody because of one thing they said or a funny joke they told? I doubt it, right? I'm not saying you'll be marrying your advisor. That would be silly. But make no mistake about it, it's coming from somebody who has been an advisor for well over 25 years. I know intimate details of my clients' lives that some of their closest friends and family members don't even know. My world's all about confidentiality because it's based on sharing of information. The more your advisor knows about your assets, your lifestyle, your family, your goals, and your fears, the better job they can do for you. So let me ask you this. Would you be open to sharing details about your life with the advisor who was the cheapest or gave the most right answers on your data sheet, but who was also a real jerk and gave you weird vibes? Or is there someone you interviewed who just made you feel comfortable? Somebody who was easy to talk to. Somebody you can see yourself talking to like this person throughout the next year, the next decade, even the rest of your life. Most good advisors have an incredibly high retention rate. They become invaluable to their clients and genuinely care for their well-being. And that's the advisor you should choose. If you haven't found someone like that yet, keep looking. They're out there. I promise you. I work alongside of them each and every day. That's all I have for today's episode of Blue Collar Wealth. I really hope that you found this helpful. If you did, please subscribe, give us a like, and drop a comment below if you have an additional question maybe that you think is pretty good to ask for potential advisors as you're going through that interview process. And I wish you the best of luck and keep us on that list. We'd love to chat with you to see if we're a good fit. Until then, I'll see you on the next episode. Thanks.